Thanks so much for coming out this morning. Just to start off with maybe just a quick show of hands, how many people in the room would like to pay more tax this year? That's weird. Nobody has raised their hand. So clearly you're all here because you'd like to learn about opportunities to pay less in taxes. And that seems to be a shared interest that we all have. So just to kind of give you a quick overview of what I plan to cover today. I've handed out a tax reform cheat sheet. I guess, does everybody have that right now? Okay, so I'll make some references to that as we kind of proceed through this conversation. I've got a quick bio background. Heard a little bit from Tim already on who I am. And then just for kind of framing of this conversation, want to cover some just nuts and bolts of taxes in general, so we've got kind of shared terminology. And from there, we'll jump into tax reform, the background, key changes impacting businesses, key changes impacting individuals. Now, I will say to you guys, I already know all this information, so really I'm here for your guys' benefit. So in other words, please cut me off, raise your hand, shout out, whatever you feel comfortable with. If you want me to clarify something or get into more details, I'm not offended. Like I said, I know this information already. It's really for your benefit. With that, just to kind of jump into some key takeaways that I'd like you guys to walk away with today. First is that the tax code it's always changing. This particular situation, tax reform, and I always kind of do quote unquote reform because reform is kind of a relative term. Not everyone was made better by this. So it's really relative to your situation. But the tax code is always changing. This bill was 700 pages long, more than 43 provisions that impact individuals and small business. So this was significant. And any of the narratives that are out there about this being the biggest set of changes over the last 30 years, I would align with that narrative. So it's substantial, but in general, on any given year, there are hundreds of tax provisions that are changing, and that's because not everything in the tax code is permanent. So there are provisions that are expiring, sunsetting, whatever terminology you want to use. And so it's always this evolving thing, and so you have to sort of pay the least amount of tax, you need to be aligning your circumstances with the code. But what we're seeing in the models that we've been running with sort of the changes that happened is that with the right planning and right strategy, there's about on average 7.5 percentage point decrease in the amount of tax that people are saying. So to put that in context, for every 100,000 in income, and these are averages, we're seeing about 7,500 less in tax. So if you had, so you can sort of scale that out and think about how much additional cash flow that could be if you're at 400,000. 7,500 times 4, that's 30 grand, that's a lot of money. So with the right planning, there's significant savings that are out there. So let's kind of get into some things here. Real quick, my bio, I'm a CPA. Founded Nth Degree about 8 years ago with the idea of just doing things a little bit differently and leading with planning and strategy before jumping into tax prep. As Tim mentioned, I've been named a top 40 under 40 accountant 3 times, and the last thing is something that only accountants tend to find cool or interesting, which is I started my career at the boards that create accounting standards, so I helped write an accounting standard, which, like I said, accountants think that's cool. Normal people think that's pretty boring, but put it in there nonetheless. So let's get into some tax background. So here in the US, we have the federal government, and that's really what we're talking about, federal tax code, income tax. But there's actually over 89,000 state and local governments across the US. And so there's not exactly 89,000 taxing authorities, but there's more than one, and there's more than 50 states. In fact, there's tens of thousands of taxing jurisdictions. So to really optimize your situation, you have to be thinking beyond just the federal tax system. But as you might imagine, with 89,000, that is really case by case in terms of someone's individual situation. So couldn't necessarily speak to all of them, nor would you want me to. When we think about tax, kind of more specifically, we've got federal government, and within that we've got income taxes, self-employment taxes, and then in some cases excise taxes. Just some terminology for you guys. And then at the state level, it varies. There are 43 that have income taxes, 7 that don't. We live in Washington. We don't have an income tax. We have sales taxes and other types of taxes, property taxes. And then at the local government level, and when I say local, I mean cities, counties, things of that nature. It really varies all over the board, from income taxes to different types of excise taxes, and those deadlines really vary. In terms of types of federal taxable entities, we've got C corporations, S corporations, LLCs, partnerships, sole proprietorships. Again, just as context, I'll move through this quickly. C corporations, they file their own separate tax return. They're really viewed as their own kind of entity or person. They pay their own tax, and then when the shareholders receive income dividends, they pay tax on that income as well. S corporations file a separate return. They're considered a pass-through entity. Pass-through just means the taxes are paid by the shareholders or partners, members, whatever terminology you want to use in that regard. LLCs, it depends, and this is where sometimes people are confused. LLC is really a legal matter, how Washington State or the state that you're registered in views you. By default, if you have one member, you're a sole proprietorship. If you have more than one member, you're a partnership, and then you can elect to be an S corporation. So sometimes folks get confused when they're asked what type of taxable entity you are. They say, oh, I'm an LLC. That really depends on your circumstances, and you want to keep your LLC license active, regardless of if you've kind of elected to be an S corp. Partnerships also file their own separate return. They're considered pass-through. And sole proprietorships, those entities where there's only one owner and they haven't elected to be an S corp, are also pass-through. They pay their own tax, the owners. I guess any questions about that or any confusion people have around kind of entity structure and how all that works? Okay. So let's talk about what I like to call the CPA Job Protection Act, but it's more specifically known as the Tax Cuts and Jobs Act of 2017. Also referred to as tax reform. And again, I put this in quotes because reform by definition means to have made something better. That's really, again, a relative position depending on your circumstances and how you sort of optimize things. It was passed on December 22nd, 2017. So unfortunately, Congress doesn't usually give us a lot of time before the year is up to pass these things. But for the most part, for small to medium-sized companies, there weren't really any provisions that would impact you for 2017 purposes. There are a few things that came into play, but for most small businesses, individuals, everything really is going to impact your 2018 tax return. So even though it came at the end of the year, it's really for 2018 forward. And it amends the tax code. And as I mentioned, there are more than 40 key changes that relate to individuals and small business. If you look at the cheat sheet that sort of passed around, it's double-sided. One is individual matters, the other is business. And I think I counted 43 that we listed there. That's not all of them, and that's just a quick summary of items that are on there. There's other stuff that's international tax related or kind of bigger C corporation related that we don't have on there. If you have international tax matters or large C corporation, we should really talk about those things probably offline because it gets pretty meaty and hard to summarize in like one line item. In terms of just kind of some facts about this specific bill, the Congressional Budget Office reports that pass-through entities, so partnerships, S corps, sole proprietorships, over the next 10 years will receive about $1 trillion in benefits. That's $1,125 billion over the next 10 years. So it's pretty significant. And corporations would receive about $320 billion. Now the thing to know is that the C corporation rules are permanent. So they're not set to expire or sunset. The pass-through rules, the S corp partnership, sole proprietorship stuff, that starts to go away and they actually turn into tax increases after 2027. So for the next 9-10 years, you really need to make the most of this, assuming that there isn't some sort of congressional intervention where they change the code again. So just more of an FYI on kind of this isn't a permanent landscape, and an example of the tax code is always changing, and you always need to be thinking about how do you make the most of your circumstance relative to the current code. So with that said, get into some of the details of the act itself, and starting with C corporation. So the first thing to know is, I guess, does anybody have a C corporation that's in the room currently? Okay, one person. Anybody else? Has anybody been wondering if they should convert to being a C corp based off things they've heard in the news? Okay, so first off, the C corporation tax rates have moved to a flat 21%. Previously, they went up to close to 40%. But there's still a double tax, meaning the corporation pays its tax and then its shareholders pay a dividend tax. And in every scenario that we've modeled out, it still results in a higher tax, total tax, if you move to a C corporation versus S corp or partnership. So the reasons for people becoming a C corporation to begin with have remained the same, which is if you expect to get venture funding or eventually go public, have a lot of shareholders, more than 100 shareholders, C corporations, that's when they make sense. From a total tax perspective, pass-through entities tend to result in lower tax. So the exception is something that's actually existed for more than 5 years. So it is not part of tax reform, but commonly not known about. It's called the 1202 exclusion. Anybody know about the 1202 exclusion? People always get really excited when I reference tax code, like, yes, give me another tax code reference. I only have a couple in this presentation, I promise you that. It's also called a small business C corporation. And basically what this provision allows for is if you've elected to be a C corporation and you held the corporation for more than 5 years from the time that you made the election, and you sell it, the first 10 million in gains, is excluded from tax. So if you sold a company, if you converted today to a C corporation and you waited 5 years and you sold it for $10 million, you're going to save $2 million in tax. That's pretty cool, right? Now, the challenge with that is, do you know that you're going to hold the company for 5 or more years? Do you know that you're going to sell it for up to $10 million? And how profitable is it going to be during that period of time? Because if it's a really profitable company, you might actually end up paying more in taxes as a C corporation with all the double tax issues than you save with this exclusion. So this exclusion tends to work for your tech companies that expect to have a loss for several years, so they're not paying any income tax, and then they sell it to, say some company like Amazon who cashes them out for kind of a windfall, and then they're completely exempt from tax. And this is $10 million per shareholder. So if you had 5 shareholders sold for $50 million, $50 million is excluded from tax. So that's really the scenario where C corporations make sense. So if you were a C corporation, your rates went down. If you're not a C corporation, unless you expect some windfall with losses, it doesn't make sense. Let's see. But we do have a new, completely new to the tax code scenario, which is why I call this the CPA Job Protection Act, because this added in some additional layers of complexity, as you'll see as I attempt to explain this to you in a digestible way, and also requires a fair amount of end-of-year planning. So first off, this pass-through income deduction, and again, this is if you're a C corp, if you're an S corp, partnership, or sole proprietorship. Good news, you get to exclude 20% of your profits from tax. I'll wait for the gasp. So if you had...
So that does or does not include an LLC?
It would include an LLC if the LLC was not taxed as a C corp. So if the LLC was taxed as an S corp, a partnership, or a sole proprietorship, this would count. Yes?
In one version of the bill, I thought
Yes. Yeah, that's the second piece to this. So good news, you might get to exclude 20%. Bad news is that if you're a service provider, there are some additional restrictions. Okay, so as a starting point, say you have 100,000 in profits, you get to exclude 20% of that 100,000, so you're actually just paying tax on 80,000. That's sort of the starting point. But there are limits that apply, and those limits initially kick in if your total taxable income is 315,000. So there's a starting point of if you're above 315,000, you may have some limits. Okay. The next piece then is, are you a service provider or are you not a service provider? Who thinks that the definition of service provider is very clear in the tax code? It's not. They've specifically named certain professionals that are deemed service providers. So apparently, Congress has an issue with CPAs. We're called out. Like, come on, we got to enforce this, and we get limited on this deduction. That doesn't seem fair to me. But we're specifically called out as service providers, attorneys, medical professionals, and there are a few others that are specifically named as service providers. And then it's somewhat left open-ended as to what it means from there. So, yes?
Insurance people?
I don't know that insurance was specifically called out.
Oh, sweet.
So, might be good news. And as it stands currently, the IRS has not issued any regulations or any interpretations of the bill. In fact, within the last couple of weeks, they requested, I think, about $1 billion of additional funding in order to implement this bill. So they're understaffed, under-resourced, and now they have a 700-page bill with an entirely new structure built into this that they need to somehow interpret and then implement and then try to hold people accountable for it. So a lot of folks are thinking about ways that they can position themselves as not a service provider. This is really the planning opportunity. If you're not on the list, you're not lucky enough to call yourself an accountant, then, or one of the other named professionals, then does that create an opportunity where even though you deliver a service, you don't in terms of the meaning of this bill? Because I'll tell you why. If you aren't a service provider and you make more than $315,000, your 20% deduction is limited if 20% of your profits is greater than 50% of the W-2 wages of the business or 25% of the wages plus 2.5% of unadjusted basis. Pretty clear to everyone? Like I said, this is the CPA Job Protection Act because everyone's like, what is that? Are those even real? Are those English words that you just said? So 50% of wages, that's a relatively easy one. Take the total wages of the company, multiply that by 50%. That's the maximum amount of income that you can exclude. For most businesses, 50% of wages is going to be more than 20% of profits. So if you're not a service provider, you're probably not going to get nailed by that. But there are certain companies, say, you could imagine maybe a large real estate holding company that doesn't have a lot of employees or wages, but they have a lot of assets. And maybe those assets have been depreciated significantly. And so unadjusted essentially means what did you buy the real estate for? So for scenarios, if you're a real estate holder and you don't have a lot of wages, you might have a lot of assets that you've purchased, buildings, and so that exclusion may still apply to you because you get to take 2.5% of what you paid for those properties. So there's a lot of speculation. I won't politicize this too much on why this favorable real estate provision was added, but it is very favorable if you have significant holdings in that regard. So and it's either one. So 50, whatever's greater, 50% or 25. Is that any questions on that?
Will you be circulating the stack once you're done?
Yes. Yeah. If you are a service provider, then the scenario well, let me kind of walk you through the way that that works. So say that you're a business with $500,000 in revenues, $200,000 in expenses, so your profit's $300,000. You're under that $315,000 threshold. You don't have to worry about any of the exclusions. You don't care. You get to exclude 20%. That 20% is $60,000. Under the new tax code, you'd be in the 24% bracket. You're going to save $14,000. You didn't do anything different from the previous year to this year. You just saved 14 grand from this exclusion. Now, say that you are a service provider and you made $565,000 in revenues, $200,000 in expenses, so your profit's $365,000. So you are above the $315,000 threshold. Well, once you get to $415,000 in profits, you don't get any of the deduction at all. So basically, that 20% phases out as you get up to $415,000. So if you're at 365, that's at the midpoint between 315 and 415. So your 20% exclusion is going to be reduced by 50%. So instead of getting the $60,000 exclusion that I showed you previously, you still get an exclusion. So you're still better off than you were previously, but you're only excluding $36,500 at a 24% tax rate. Now your savings goes down to $8,800. There's a fair amount of math you got to do to calculate this exclusion, right? So what are the takeaways from this? One is, if you are a service provider, end of year planning is becoming much more significant about how are you managing profits to stay below the 315 threshold. So you may be prepaying expenses at the end of the year to try to get below that threshold, because it becomes this multiplier of having additional income that now you're paying tax on, and you're losing out on the exclusion on top of that. Additionally, you just don't want to be a service provider in terms of this, right? Because chances are 50% of wages for your company is going to be more than 20%. And so how do we make sure that you're not a service provider? And like I said, in some instances, you can't get around it because you're specifically called out. But if you aren't called out, then you have somewhat of a decision point about how comfortable am I with gray and how aggressive do I want to be with my tax approach, right? And so some of the things that we've been brainstorming are maybe you want to change the way you describe the company on your tax return. If your tax return currently says, for the description of your business, service provider, you probably want to change that, because the code says, that if you're a service provider, you hit this exclusion. So changing the description of your company on the tax return may make sense, depending on how it's described right now. Changing the code, the 6-digit code for what type of business that you are. A lot of tax returns that I look at, that code defaults to other service provider. Again, if there's a product component to your business, a retail component to your business, something that's outside of the definition as it currently stands, you probably want to change that, because you're really increasing your audit risk with the IRS, because you've specifically described yourself as a service provider, and then you're not using the service provider limits. So those are a few things. Some folks that are really aggressive with planning are making wholesale shifts. I've heard of accounting firms who are thinking about buying their building now and renting part of it out. It's like, okay, am I not completely an accountant? I'm also in real estate, and there's some real estate rules that are favorable. And so maybe I've shifted the structure of my firm a bit where I can exclude a portion or allocate a portion of my profits to this non-service provider rule. So this is where there's a lot of kind of one-on-one planning opportunities to make sure that you're not structuring yourself in a way that you're clearly meeting this service provider rule. Any questions about that?
If you're not a service provider, what are you, manufacturers?
As it relates to this code section, you're either a service provider or a non-service provider. Yeah.
And what was the point of, I guess, isolating the service providers?
Good question. this is where you kind of have to get into what's the politicizing aspects of the bill being created, and and this is just conjecture on my part. When they started down this process, there were a lot of promises on how a tax return would go from being really complex to we're going to put H&R Block out of business and it's going to be on a postcard. And so there's a big narrative on simplifying the tax code. Well, as you can see from something like this does not simplify the tax code from my perspective. So I think there's a bit of, well, we didn't simplify the tax code, but for those people who would benefit from this, accountants, attorneys, you don't get the exclusion. So I think there's a little bit of kind of maybe positioning in that regard. That's just editorializing on my part. I don't know that for sure. The other piece is that to get this bill through, there has to be some revenue-raising components to it, and that over a longer period of time, it can't substantially increase the deficit. Otherwise, you'd require like a supermajority vote. Right? Well, we know this does increase the deficit, but in terms of the way the rules are structured currently, they were able to get around the filibuster rules by adding in some revenue raisers. So I think this was one of them that had to be added in order to make the overall numbers work. Those are just some thoughts that I have on that, but there's probably some inside info on that I'm not necessarily aware of. Any other questions on this front? This is probably the most complex aspect of the bill that would impact business owners, and obviously is not necessarily simple math because of the prorated aspect and also knowing what your actual taxable income will be. A couple other things around depreciation. Something called bonus depreciation was increased. Basically what this means behind all kind of the details is that in general, if you're buying assets, you can go ahead and just expense those. Same with something called Section 179. Those limits were increased, and the type of property that you can apply this to changed, which basically means that if you're considering buying any sort of equipment or trying to do some modeling around what your cash flow is going to be after you buy this equipment, most likely you're going to be able to just take that expense in the year that you purchase it. Couple other things just for consideration that weren't necessarily a part of this, but just are opportunities that we're seeing out there. One is the Masters rule. Who likes golf or familiar with the Masters? Other people call it the Augusta rule. So the Masters is in Augusta, Georgia, relatively small town, not a lot of lodging and such. And then you've got thousands of people who are coming in for this tournament. So what happens is people are renting out their homes and for 4 days, 5 days. Well, this specific exclusion says that as long as you rent out your home over the course of the year for less than 15 days, you don't have to pay tax on any of that income. So for people in Augusta, they might be renting their house for $10,000 a day. That's completely free of income tax. So one strategy that we are trying to roll out this year that I think aligns with this Masters rule is maybe you host an event at your house for clients, and so the business is renting your house for some amount, $1,000, $5,000. That's an expense for the business, income to you, except it's not taxable income because you just did it for 1 day. You didn't do it for 15 days. So maybe the company rents a office in your house for 14 days out of the year for $1,000 a day, $14,000. That's a business expense. It's not taxable to you. If you're in a 25% tax rate, just for simplicity's sake, that's $3,000, $4,000 worth of tax savings. So it's called the Masters rule. Opportunity to think a little bit differently about events or how you might be using home office. So that's something that's come up recently that we've been looking at. Any real estate investors in here, folks who own commercial real estate? Okay, so cost segregation studies. This has been around for a while. Cost has gone down on this. So even if you just have residential real estate that you're renting out in Seattle, the cost has gone up so much that doing these studies now makes more sense. Basically, it involves having an engineering firm come look at your property. They come back and they say, hey, X percentage of the building is related to HVAC, windows, doors. Those all have much shorter depreciable lives. So rather than depreciating something over 39 years, how about we depreciate a third of the purchase price over 5 years? And oh, by the way, that 5-year property now qualifies for Section 179 depreciation or bonus depreciation. So let's just take that entire expense this year. So that's been around for a while. If you haven't been using that for commercial properties, that's an opportunity that you should be taking advantage of. If you have residential real estate in the greater Seattle area with the costs going up, the savings that you get now is making more sense. So that's been around for a while. The last two are really relatively new in the last couple of years. DeMinimis safe harbor election. This allows you to add, every business return should have this election because you can't amend and add it later. So if you look at your business returns and you don't have this on, you want to make sure that it gets added. It allows you to directly expense, so not even deal with depreciation on items $5,000 or less. And it's per item on an invoice. So you could have $1 million invoice, but each line item is $5,000 or less. You just go ahead and expense that entire invoice. So if you did a remodel, tenant improvements, sort of thing, before maybe you were capitalizing and depreciating, now we get a detailed invoice. We just go ahead and expense all of that. And then when you sell it, because you didn't depreciate it before, you don't have to deal with what's called depreciation recapture and paying higher than capital gains rates. So it's a way to significantly increase the amount of assets that you're directly depreciating. This would be the same with computers, anything with your building. And then the last thing really quickly, partial dispositions. The idea there is that you can't really have two roofs on a building. So when you tear off that roof to build a new roof, you've actually partially disposed of part of that asset, and maybe that's $1 million building, and that roof is 10% of the value. We now take a $100,000 loss in the year that we do that, and then when we build the new roof, we get itemized receipts, right? And then we directly expense all of the construction of that new roof, and we don't deal with depreciation. So that allows you to now add, maybe several $100,000 in expenses that you would have otherwise been depreciating over, say, 39 years. So just a few ideas for you guys. Any questions on those? Okay. So kind of shifting gears to individuals. As you can see, the tax rates have changed. This is married filing joint, but similar for, I can get you guys single rates or head of household if you want. Moral of the story is that in the upper end, 39.6%, that's gone down to 37%, so nearly a 3 percentage point change. But additionally, in the lower ranges of income, the rates have gone down and the rates have expanded. So you could see that 25% is now 22%, and there's more at that range. So for most folks, this is a couple of $1,000s extra for every $100,000 in income, just based off the changes.
Can I ask a question?
Sure.
You said you showed head of household. Isn't head of household permanent? I thought that you could no longer.
That
head of household.
I'm not sure on that then, if that's the case. Maybe part of what you're speaking to is that there's no longer any personal exemptions. So it used to be you'd start a job, you'd fill out a W-4, and you'd say, married, single, and then, how many kids do you have? And you'd add all those up and come up with a number, and there was a value for each one of those exemptions. That no longer exists. So last I checked, the new W-4 forms hadn't been issued yet by the IRS, but soon. I'm looking at Kyle from Paychecks on that. But from my understanding is that the the withholding rates. So because there's a new tax rate structure and because we don't have exemptions anymore and because we've got this change in standard deduction that I'll explain in a second, the amount that's being withheld from paychecks has changed. And the form that you'd have a new hire fill out is going to be different because they don't do that math anymore. So this was an attempt, I think, to simplify the tax code, got rid of personal exemptions, but we increased the standard deduction. And so this is just the deduction that everybody gets, and it's where you compare, should I itemize, where I'm adding up like mortgage interest and property taxes, or should I take the standard deduction? So if you were taking the standard deduction before, this is good news because it increased potentially, but if you've got a lot of dependents, a couple of kids, potentially net, you're incrementally worse off in terms of the amount of taxable income. But maybe a positive is that if you do have kids, child tax credits increase from $1,000 to $2,000, and the income threshold went up significantly. So a lot of people in Seattle, double income earners before, phase out was at $110,000 in income, and so most people in Seattle, especially if they're dual income, they make more than $110,000. Got a kid, they're not getting to claim this tax credit. Now that income level is $400,000 and it's $200,000. It's $2,000 per kid. So a lot more folks are going to get access to that tax credit now. And then 529 plans, if you set those up for kids, before it was for a college fund, now you can use those funds for private school K through 12. Last couple of things on the individual front that I just want to call out. Like I said, on that sheet there are, I'm not touching on all of them, so if you see something on there that you want to talk about, let me know. But a couple other things. No longer does the itemized deduction get phased out, and so what happened before is as your income went up, the value of your mortgage interest deduction and those other things got decreased. So that's gone away. So that really helps higher income earners have more deductions. However, and I'm sure you guys have heard about this in the news because at the end of the year a lot of folks were trying to see if they could prepay their property taxes. State and local tax deduction is limited to $10,000. It wasn't previously limited. So this would be property taxes, sales tax. You're limited at $10,000. However, maybe a hit to if there's any estate attorneys here, estate tax exemption has doubled from essentially $5 million to $10 million. So the point at which you have to do estate planning for 2018 forward has shifted a bit. With that said, that's really the end of the content that I had. Is there any questions you guys have about either what I've covered, anything on the cheat sheet, or just in general? Yes, please.
On the back under impact to businesses, the line about meals.
Oh, okay. Yeah, so meals and entertainment. Previously, you had sort of this distinguishment between is this meals with clients or entertainment with clients, or is this something for the benefit of the staff? So it's like a mandatory meal, or you've offered food for the staff, whether on premises, and so you kind of distinguish between stuff that's for the convenience of the employer is 100% deductible, stuff that isn't 50%. What's shifted now is that any entertainment expense, so going to a Mariners game, Seahawks game, any of those sort of things you might take your clients or employees to, no longer a business deduction at all. So those events that are deemed entertainment, you no longer can deduct. On the meals front, I've seen some differing interpretations. I've talked to some CPAs who believe that you can't deduct meal expenses whatsoever, 50% or 100%. That's not my interpretation at this point. I think meals are still a deductible expense at 50% or 100%, but we're going to wait for the regs that hopefully will come out and give us a bit more clarity on whether or not meals is going to go away as well. But I'm not expecting that piece will.
So, estate tax for the state level?
For Washington.
Estate tax, the estate tax threshold for the state for Washington.
To my knowledge, the Washington state exemption has not changed. Yeah. I think it's $2.5 million.
2.5.
I got a question on the safe harbor expense deduction.
Yes.
Is that expense, is it the accounting of that, would that be listed as a separate expense from maintenance, or that be bundled in, or does it matter?
So I think it's a good question because it has implications for financing. And when you go, yeah. So yeah, so you certainly have this. This is where you can optimize your taxes, but then your financial performance maybe doesn't look so good, and then that has implications to your ability to get access to financing. So really, I think what you want your tax preparer to be doing is to specifically call out DeMinimis expense as a line item. That's the most ideal, I think, if you're expecting to get a loan. So you can have that added back, similarly to how you might have depreciation or other non-cash things added back. I think often what happens is they get lumped in as office supplies or maintenance. And in that case, you might see the election on the return. I mean, you'd have to see the election. It's a statement saying we claim under this specific provision. But you're not going to be able to figure out from the return if they've bundled it, how much. Yeah. Jason?
Is this code attractive to a business that maybe was considering an exit or a merger or something like that? Is this, or is it just neutral? Is this code advantageous for somebody who's planning that?
Good question. So is it advantageous if you're planning on selling or acquiring a business? I think from the acquisition perspective, there's sort of, do you want to do an asset purchase or buy the company? And usually buyers want to do an asset purchase, sellers want to sell the company. Because of these expanded depreciation rules, doing asset purchases are even more favorable just because there's more assets you could expense in the first year that you bought it. In terms of selling, anytime tax rates go down, that's a benefit. Capital gains rates haven't necessarily shifted, but ordinary rates have. So when you have more capital gains, then more your income is, then your ordinary rates go up as well. So there's sort of this multiplier effect in that case. So I think it's, moral of the story, kind of thinking out loud on that, I think it's advantageous for both the buyer and the seller. Yeah.
Could you confirm if the new tax bill did away with new market tax credits? I was reading somewhere where that's no longer a program.
I'm not, to be honest with you, I'm not sure, but I can confirm that for you separately.
So
Yeah.
really quick about meals. So for so it means we could separate meals from entertainment. So here meals, does it include meals with clients?
So my interpretation right now is meals with clients still 50% deductible. Meals with the staff, like on-premise or required staff, holiday events, still 100% deductible. If you went to so those, my interpretation is those are the same as before. However, if you are going to taking clients or employees out to a Mariners game, Seahawks game, something to that effect, those tickets would not be deductible. If you bought the meals while you were there, that would be deductible.
Oh, okay.
Yeah.
The transportation fringe for businesses you can eliminate, what's that?
So bus passes, bike reimbursement, and parking. So previously there was an exemption, I think it was last year, $265 per person for parking that was tax-free. That's now taxable.
And then all of this is for 2018 tax year, so we'd be dealing with it a year from now.
Correct, yeah.
So it doesn't change anything.
If you've got employees, though, that you're paying for doing these reimbursements, then by the end of the year you would need to get that added to their W-2 for the transportations. Yeah. Yeah, they don't like that. Good question.
Can the individual, though, take it as a deduction?
Good question. So unreimbursed business expenses used to be something that if you itemized, you could claim. You can no longer claim unreimbursed. That's gone away. So one thing that we are kind of pushing out for anyone who's a business owner is to enact something called an accountable plan. That accountable plan is a safe harbor document that allows you to reimburse yourself for expenses. So if you've got mileage, home office, things like that. You want to have that accountable plan in place so you're reimbursing yourself and not running into the issue where it would be deemed unreimbursed and you could no longer deduct that.
Is there something similar like that to protect employees from having to be taxed on their benefits? Is there some way, tax planning approach to that?
To pay for to continue to pay for their parking and.
Work hard.
There's not necessarily a way for it to not be taxable. You could gross up their wages to pay for that additional tax. That's going to cost you or the business more. The other argument is, even though I'm including this as taxable wages to you, because of the tax rates, you're probably still paying less in total because of the rate changes. That's a little bit harder sell, but unfortunately. I mean, you could get creative. This is just thinking, like, are they a few days a week working from home, in which case you could reimburse them for their home office expense? That's a scenario, I guess, that maybe would offset what they're, so rather than paying for parking, maybe you're reimbursing them for their home office. So they end up with the same amount, it's just a different type of reimbursement. I'm just kind of shooting from the hip on that as an idea of something you could do.
Subjective question. What part of the recent changes was most surprising to you?
What part was the most surprising? I would have to say this 20% deduction, just because it's so new. It actually started at 25% and then 22%, and then ultimately the deal got done at 20%. It's surprising that service providers are called out in the way that they are, just because that feels a little bit more punitive than the tax code usually is for service providers versus not, and feels a little bit like an attack on the new economy, just because you have so many digital marketers and Facebook ad people and folks who might be ultimately deemed as service providers once the regulations come out. So surprised by how unclear it was, but also how potentially punitive it could be for younger folks.